Peter Lynch, a renowned figure in the world of finance, shares his insights on the stock market and the importance of understanding market volatility. With a wealth of experience, Lynch offers valuable advice to investors of all ages.
There's an incredible rate of illiteracy in our public. These people have had no experience learning about the stock market. It's a tragedy. You purchase a stock, do certain things, you will do better. If you're not ready to do those things, you should keep your money in the bank.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done?
I love volatility. I remember when 1972, the market went down dramatically and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close. I started buying at 7, but I kept onto it and it went to 1. It was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field and the market will go down or the market will go up. Volatility will occur and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try to figure out mutual funds they own and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year and stocks will follow. That's all there is to it.
Peter Lynch discusses the issue of illiteracy in public finance, emphasizing the importance of education about the stock market. He expresses his love for market volatility and believes that it presents opportunities for investors. However, he also highlights the need for market regulations to prevent excessive volatility for the public's benefit. Peter Lynch mentions that corporate profits historically grow at around 8% a year, leading to stock market doubling every 9 years, and he expects this trend to continue in the future.
You should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. So 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine. You're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. People tell you about it after the fact that they predicted it, but they predicted it 53 times. So you can take advantage of the volatility in the market if you understand what you own. The stock market, I think of it more, if people study chess, this would be not a good game to study for the stock market. Because in chess, an outstanding player will beat a good player 1,000 times in a row. So everything's in front of you, all the moves are known, it's all technique. In poker or in bridge, there's a lot of uncertainties, there's a lot of things you don't know. You can play a hand exactly right and lose. You say, but I played it right, if I do it again overnight, over a month, I'll do it. That's the stock market. The stock market is much closer to poker than it is to any other game. And I think that's what's the important thing to know. This is important whether you're investing for a 4-year-old, a 14-year-old, or a 74-year-old. You have to say, what am I going to do when the market goes down? Because I've had audiences like this, larger audiences, and I'll say, how many people in the room are short-term investors? I've never had anybody ever raise their hand. I mean, everybody in the world is a long-term investor until the market goes down. No, but seriously, I think it's very important that people understand when they own a bond fund, that bonds can go up and down. Bonds are just about as volatile as stocks. If they own a 30-year bond fund, that you can lose 25, 30% of your money very fast, even though they're government bonds. People have to understand this.
Peter Lynch emphasizes the inevitability of market downturns and advises investors to study history. He compares the stock market to poker, highlighting its uncertainties. Lynch stresses the need for a plan to handle market volatility and cautions about risks in bond funds.
There's an incredible rate of illiteracy in our public, and all they ever hear about is what happened today to Bristol Myers going up $2 or $3, what happened to Dow Jones. They don't get to learn anything about America. And people at some point in their career are presented, they're near retirement, they're given $450,000, $500,000 because it's an early retirement. They have no experience, they don't know what a bond is, they don't know what stocks are. They have to make a decision in 30 or 60 days when they have a big tax consequence. These people have had no experience learning about the stock market. It's a tragedy. So I think anything we can do to educate the public, if you can convince people, if they understand the volatility stock market, I'm not saying anybody should buy a stock. I'm just saying if you purchase a stock, you ought to do certain things. If you purchase a stock, do certain things, you will do better. If you're not ready to do those things, you should keep your money in the bank. Keep your money in a money market fund. Some people aren't willing to do the homework, they don't have the stomach for it, they should stay out. They're not doing anybody any good by taking half their life savings and putting in the stock market. Or they've been lucky enough to save $50,000 or $60,000 to send their kids to college, and one's going to start in a year, and they're going to take all that money and put it on an equity mutual fund with a one-year horizon. That's doing no one any good. So I think the more, whether it's the banks that explain it, the brokers that explain it, if they understand them, they'll do better with it. So I would say if you want to buy a small growth fund, or you want to buy a balanced fund that's part bonds and part stocks, you put so much money in, more in every year, you'll be very pleased in 10, 20, 30 years.
In a world where financial literacy is lacking, Lynch emphasizes the need for education and informed decision-making in investing. Whether you're a seasoned investor or just starting out, his wisdom reminds us that embracing market fluctuations can lead to long-term success in the ever-changing world of stocks.